Let's talk to Marc Ostwald. He is a strategist at ADMISI. Very good morning to you, young Marc.
Very good morning.
Right, we have 5 thought-provoking slides. Without further ado, let's kick off with the first one, the US dollar index. What is this telling the crowd?
Right, the first 2 slides are in the category I'd call dispelling myths. So we've been talking a lot, everything I noticed while I was away in Poland this week, that the Chinese yuan is collapsing. Well, that white line on there is the so-called Chinese yuan collapse. It's a fairly sharp move, but if we look at it,
6% in 6 months, right?
Yeah, and in fact we are still above where we were in December of last year, and certainly way above where we were back in June of last year. So it's not actually. People always forget, they look at the moves against the dollar and think that the Chinese are still targeting the yuan versus the dollar. They're not. They're targeting against that basket. And on that basis, when the dollar's strong, it will lose some ground. Meanwhile, the dollar appreciation, yes, it's quite substantial. But if we look at it in the greater scheme of things, again, we're not really much above where we were back in last December. So a little bit of perspective here is needed. Yes, I think really what it tells us, it's been a choppy week to end the quarter, and I think that is probably something which I'll come back to in a moment in terms of what happens going forward. But there's certainly, this quarter has been about the market realizing that the Fed is serious about its rate moves, and the old maxim of, well, actually they're probably overestimating how much they're going to hike is no longer valid. Let's move on to the next chart, which is another bit of mythology. There are a lot of people who keep on talking about this US two-year, 10-year yield spread in terms of experiences of the last 30 to 50 years, that when the US yield curve gets very flat, often it augurs recession. Well, first of all, when the curve does invert, quite often it takes about 2 years before we get any sign of recession. So we've still got a positive curve, not much. Secondly, I think using that as a proxy for, as a signal proxy for recession, given that we've got $17 trillion of QE in the world, given the fact that dollar interest rates are so much higher than the rest of the developed world, is a little bit tenuous, given that we are still in a yield-challenged environment. So people will naturally gravitate to dollars, and they'll probably gravitate to longer-dated dollars, which will flatten the curve, particularly when the Fed's clearly determined to hike rates, so the curve just gets flatter and flatter and flatter. Does it augur a recession? Not immediately, and I really wouldn't want to use it as a proxy for that. So I think in both those categories, dispelling myths. These are not signals that one should be fretting about. The Chinese aren't going to devalue the yuan, and this doesn't signal a US recession is imminent. I still think there is a risk 2 years out, but it's not due to that.
Understood. Okay, so let's move on to the third slide.
So let's now have a sort of a little bit of a review of what's happened in this quarter and think about what might happen in the next quarter. Well, clearly what we've got there is the sharpest fall in the pink line, which is the MSCI Asia stock index ex-Japan. Obviously, that has taken the biggest tumble, and the falls that we've seen in Europe, which is the white line, and indeed the S&P, which is the white line, and the green line, which is the Eurostoxx 50, have been relatively modest. In fact, if one looks at it for the quarter, basically the Eurostoxx have done nothing. And the S&P is, for choice, up on the quarter, though obviously well down on the highs that we saw back in January, but basically unchanged on the year. So you've not done too badly there. I wouldn't exactly say it's a sign of risk off outside of Asia. So this is where the next chart sort of comes into play, because we've been talking about how things have been picking up in terms of volatility. The white line is the VIX, the green line's the VIX, so we've picked up a little bit on the VIX. We've picked up a little bit in terms of the Eurostoxx. Are we anywhere near the spikes that we saw back in February? Absolutely not. So it's actually been a very well-behaved quarter, which the lack of volatility is precisely why we haven't seen the sort of sell-off in risk assets, i.e. contagion, from what we're seeing in Asia. because it's basically an environment which encourages people to stick with the principles of recent years, reach for yield, reach for risk, and being worried that, by the dip, fear of missing out. None of that has actually really been dispelled, and in a certain sense, there's a good reason why not. The only central bank in the world of the major central banks, leaving aside Asia and Africa and Latin America, which is raising rates, is the US. Everyone else is still a very, very long way away, and therefore we are in a return-challenged environment because yield, and naturally people will seek to either sell volatility, reach for the dividend yields which are available, particularly given the huge amount of what I would call QE buyback, or rather tax reform buyback and special dividends that we're seeing in the States, which is expected to amount to about $1 trillion. That's a very big force of money coming at us. But I would expect this trend that we're seeing towards the end of the quarter to actually be maintained as we start to go through Q3. So I don't expect Q3 to be nearly as calm as we've seen in Q3. We're in a rather more uncertain environment. So if we come to the
last slide.
The last slide. One of the interesting features is, as that last slide showed, it was the emerging markets of Asia which have been struggling. Here too, I think the most impressive thing about this is the high yield average bond spread versus US Treasuries has basically been trading in a range for, let's call it, a year. It really hasn't done much at all. We've had a few spikes here and there, but every time we seem to be widening the spreads in any substantial way, and most of those moves are only about 30 to 50 basis points, which in the greater scheme of things is small beer, particularly when one looks at the moves that we had in 2016. But we have started to widen out the emerging market bond spreads, primarily because of the fact that this is mostly foreign governments borrowing in dollars, and therefore as their currencies weaken, so they're concerned. So what's this imply for Q3? Well, I think Q3 is going to be an interesting environment, because if the dollar carries on appreciating, then we're going to be in an environment where we're looking at our comparisons with 2008-9, with 1997-8, and at what point do we run into the spectre of a so-called dollar shortage? There is no dollar shortage at the moment, but a lot of the decisions now, particularly with the current countries which are exposed both to inflation from a depreciating currency versus the dollar, and indeed from higher oil prices, countries like India, South Africa, Turkey, what sort of moves do they make? And will they succeed? Because this is where the great risks lies. If one goes back to those 1997-8 and 2008 episodes, it's the point at where they furiously intervene. They start raising local interest rates so that borrowing in local rates to fund dollar position no longer becomes a viable game for the banking system. And then suddenly people start sitting on losses. They have to chase the pool of offshore dollars, because they can't borrow at home to conduct a currency swap. And that's the point at which you start seeing a lot of pressure start to emerge, and potentially escalating losses, particularly for the people who are invested in those currencies, if the interventions and the interest rate hikes don't actually work for them. And that's the point at which we get to when we start to see the risk of a contagion into other asset classes, for instance, high yield, from the fact that if people start losing money in one asset class, but because they can't liquidate in that asset class, or because they've got such large losses, they then have to start liquidating good assets in other classes. And that's where the big risk lies in Q3, to my way of thinking.
On that note, Mark, thank you very much indeed.